Hi guys, it's Arsh Ellahi, and in today's video we're going to be looking at the two different types of mortgages, interest only and capital repayment, and we'll be looking at the pros and cons for each. So before we do that, I need a small favour from you. Can you press the notification bell and also subscribe to the channel? Every time I release a new video, you'll get notified of it. And you'll be doing me a small favour as I try and increase in the YouTube rankings. So let's get moving straight on. So I suppose I should start with the definitions of what the two different ones are. So we've got capital repayment. So when it comes to capital repayment, it is exactly that. The word, or should I say the clue, is in the phrase repayment. You're actually repaying the debt. You're actually repaying the mortgage over a period of time. And just to give you an example, if you take a £100,000 loan over a 25-year period, which generally is a 25-year period when you take a buy-to-let, over that 25-year period, slowly you'll be coming down. I've got a couple of illustrations, you know, with all due respect, they're not fancy or glossy, but hopefully they'll get across what we're trying to illustrate. So over a period of time, you're going to be paying the debt, and the aim is that at the end of the term, you should have repaid that mortgage in full. Now, we'll look at that because it is a little bit more complex than we think. Now, the other one is interest only. Now, with interest only, it is pretty much that you are only paying the interest level. You're not chipping away at the debt. You're not paying back any debt. And the debt level will remain the same throughout the whole period of the mortgage. And again, there are pros and cons. Now, the one thing I should say, and here's my slight disclaimer, this is not IFA, this is not financial independent advice. And if you were to go and get mortgages, please go and consult with someone who is fully qualified to provide you with the correct advice. Now, let's get moving on. So, capital repayment. I'm going to do a quick drawing actually, just to try and make it a little bit easier for you. And so, I'm going to just quickly do a quick line there, and that's, I'm going to call that IO. Okay, right. So, in my drawing, here we go. So I told you it wasn't glossy. So here we've got a timeline. So on our graph here, we've got the debt level. We start the debt level 125. The debt level will then go to 0. And then we've got the time frame. So starting from now to 25 years. Does that make sense? So we've got our two axes there. We've got debt starting from high to 0. Then we've got time from now to 25 years. And as you can see, over a period of time, the curve will come down. Now, let's concentrate on the curve. And the reason why I say this, remember, I'm initially just concentrating on the blue line. When you take a capital repayment mortgage, people instantly assume that you're going to be paying down debt from day one. Now, that is in essence correct. However, the one thing that you should take into consideration is that for the first few years, you'll remember that the debt level is kind of remaining the same. Now, why would that happen on a capital repayment mortgage? It's very simple. The bank want to almost get paid first. So the first few years, you'll notice that if you took a £125,000 mortgage, at the end of year one, when you get your mortgage statement, you'll notice that not a lot of capital has been repaid. Because in essence, the money that you paid for the first few years, you would have just been paying the interest to the lender. So they like to recoup their interest first. It's only really generally from almost like year 5 onwards that you start to see your debt level start to decrease, and the aim at the end of the 25-year period is to be completely debt-free. Now, I know lots of people say do not take capital repayment mortgages. However, I run against the grain here. I say do take capital repayment mortgages, but this is all very much dependent upon you and your journey and where you are in your property cycle. Now, the reason why I say that is because let's look at the pros and cons. With the pros for capital repayment, you are guaranteed that the debt is going to be repaid, providing that you keep up with the repayments. Second, regardless of what happens in the property market, and let's face it, over 25 years, if the last 18 months has taught us anything, we're going to see fluctuations in the market. Price is going to go up, price is going to come down. Now, my concern for those that only take an interest-only mortgage is that their mortgage may come to an end when the prices are down. So what does that make you? That will potentially push you into negative equity. So if you bought the property for 100,000 and you got a 75,000 loan, which is 75%. Now, if you bought it when the market was high and you're now coming to sell when the market's low, potentially, and I'm saying potentially, that you could then become a motivated seller, which means that you may sell the property for less than it's worth. Now, I'm just giving you examples. Again, some of these may seem a little bit extreme, but we'll cover all of them. Now, with a capital repayment mortgage, the reason why I really like capital repayment mortgages is the fact that regardless of what the market does, my debt level will be here. So let me just quickly draw on some more lines. Let me see if I can get a different colour here. This is live, by the way, guys. So let's just imagine that. So there we go. Can we see my new lighter blue line that we've got there? Let's just imagine that that is the market. So it goes up, it comes down, we go peaks and troughs, up, down, up, down, up, down. Now, if you take the property market and the market is high and your debt level is there, let's call them light blue, dark blue and light green. So the light blue suggests that this is the market goes up and down. The light green is your debt level. So if you're on an interest only basis, your debt level will remain the same. Then you've got the dark blue, which is your capital repayment. Now on capital repayment, regardless of what happens in the market, even if the market drops at the end of the term, you're not what I would consider the slave to the bank. And the reason why I say that is because regardless what happens in the market, at the end of the term, you're going to be completely debt free. Whether that house is worth 50,000, whether that house is worth 100,000, whether that house is worth 200,000, you're in a great position. You've got leverage, you've got equity, you've got the ability to do what you want when you want. Now, the reason why I say that is because with interest only, if the market drops and the property hasn't increased in value as you envisaged, your debt level will remain the same. So that will also make you ask questions as to what you can do with this property. And I've seen lots of examples. I'll give you examples of property in Sunderland. I'll give you examples of property in Stoke, where they bought it in the height of the market. And I'll give you an example, a 2-bedroom apartment in Stoke, where they paid £100,000 for it at the height of the market, 2007, 2008. We're now in 2021. Now, in theory, that property should have doubled in value according to what everyone says. Property values increase or double over a 5, 10 or 10-year period. Now, in theory, that property that they purchased for £100,000 should be worth £200,000 today. In actual fact, they're selling for £65,000. Now, going back to my plan, is that if they've got it on an interest-only model, which is the light green one, if they bought it for 100,000 and they got 75% lending on it, that means that they've got a £75,000 debt on it. Now, if they're only selling for circa 60 to 65,000 now, they are all in negative equity. They actually owe more on the property than the property is worth. And there are properties around this all around the UK. However, if they were on a capital repayment method, regardless of what happened with that property, that debt level would have come down. And even if they're now at zero, they've still got £65,000 worth of equity in that property. Now, a couple of things I am going to mention. What's the difference between an interest only and a capital repayment in terms of costs? So when we look at the two models, because you're only paying interest and you're not actually chipping away at the debt, naturally the interest only model is going to be cheaper on a monthly basis. So if we had say two products, let's just imagine, I'm going to quickly, I can't because I haven't got my calculator open here, but I was going to say, if you've borrowed £100,000, so £100,000 is the debt level, and the mortgage payment, let's say the interest rate is around 4%, but there will be a lot cheaper products around there. The average, let's just work on the basis that £100,000, It's going to be about it is going to be about £400, £400 per annum. So work on the basis of that. That's not right, by the way. I've just realised that's not right. So you work on the basis of 4%. Now, based on the fact on the capital repayment, if you work on the basis that you're paying the interest plus the debt, naturally it's going to be more expensive. However, you've got the certainty that the debt level is decreasing and the curve is coming down. Now, you've got to think about this from your point of view. When you're investing, are you simply looking for cash flow? When you're starting out, you may think that you don't want to have an increased outgoing. So with a capital repayment, it is going to be more expensive. So you may not want to have that increased outgoing. So you may say, for the time being, I'm going to set my interest level, or I'm just going to stay with interest only. That's fine. However, you should, and the one thing I should say to you is that if you are going to go on interest only, there are other ways that you can pay down debt. And one of the ways that you can do it is some of the cash flow that you can keep. You can pay capital repayments up to 10% on an interest only basis. So let's just imagine that the debt is 100,000. Every year you can pay up to 10% of that off. However, this means that you have to be very organised, you have to be very regimented, you have to make sure that you do it. Because the last thing that you want to do is be in a position, as the example that I shared about the property in Stoke, is show that the property is now no longer worth as much as you thought it would be, and the debt level is far greater than the property value. Hopefully that kind of makes sense. So I know lots of people that do interest only, and they do it to keep their payments low. And as a result of that, they put a portion of their cash flow to one side, almost like into a savings account. And then every year they pay off 10% of the debt level. And that's the way they keep their interest level low. They keep their payments low, and they're still chipping away at the debt. And again, that is a way of doing it. Now, if you are not really that structured, and some people won't be, you can literally almost just like forget about it and put it on capital repayment. The payments come out every month. Bearing in mind that it will be more expensive, but however, you've got the certainty, going back to my plan, that the debt level, regardless, every month is coming down. You've just got to make sure you keep up with your payments. You've got to make sure that the tenant stays in there so that you've got money coming in, and it kind of works really well. Now, I set my plan very clearly back in 2007, 2008. I structured all my portfolio so that on the 11th of November 2025, all my debt level goes to zero, because on 12th of November 2025 is my 45th birthday. So I've only got a few years left. So that means that in terms of my journey, I'm pretty much around there. I'm paying off huge chunks of my capital. I'm at the latter part of the graph, which means that I'm paying off huge chunks of capital now. Now, if I was to go to a bank now, how am I perceived? Now, just imagine you've got two investors. One investor is pure interest only, which means that their debt level is still up here. Now, you've got me, who is on capital repayment, where my debt level is down here, and I've got large chunks of equity. From a lender's perspective, who is the better candidate? Because you've got to think about this. Lenders will look at you and think, is this guy overstretched? Has he already got too much debt? From my point of view, I can clearly show a level of equity. So I've got multiple angles. So when I go to a bank, I may not need further lending. What I might turn around to them and say, guys, I've got this chunk of equity here. Can you lend against that? So I could do a refinance. I may not need to take on new lending. Or alternatively, I might turn around and say, I'm buying this property, I want a complete new product. However, I can show a track record of payments and also a level of debt that's been repaid. And banks like the thought of debt being repaid. Because if 2007, 2008 showed them anything, is that lots of people were too busy and going bust far too quickly, leaving banks in the firing line. So these are all things that you've got to think of. So from a credit rating point of view, it's really good to show that you're actually paying down debt. So again, little things like having credit cards. I know this has gone completely off topic, but having credit cards, paying them off every month when the payment when the payment date is due. It's really good for your credit score. And again, when you go to lenders, they'll look to see how you've handled your debt, how you've handled your financial affairs. Now, from a bank's point of view, my financial affairs are all in order. I had debt level up here. I structured it to a point where it has come down. I've paid my interest. I've now come down on my capital. I'm quite a risk-free candidate for them to lend to. I've got lots of equity. I've shown them the ability to repay. On an interest only, if I was to have all my properties and I showed that the interest level was remaining the same, they would probably still check to see that all the payments had gone through okay, and that there'd been no defaults, etc. But the fact remains the same. The debt level is still there, and you never know. One day we could be up here in the market, tomorrow we could be there. Well, I'm not saying that's a little bit, that's quite exaggerated, but over a period of time we go through peaks and troughs. The banks want to know that there's a level of security. The banks want to have their security, and they want to make sure that they're lending responsibly. So guys, there you go. That's just my take on it. I know lots of people got lots of different takes on interest only versus capital repayment. I know lots of people are massive advocates for staying on interest only, but for me it is all about security. It's about the ability to pay down the debt. It's the ability about becoming completely financially free. I don't want the burden of having debt over my neck forever. I want to be in that position where I can say to the banks, I'm not paying you anymore, don't need to pay you anymore. And then I decide what I do with those properties. Do I sell them? How much do I sell them for? Who do I sell them to? Because again, once you've got the mortgage, you've still got to answer to the bank, because technically they still own the property. So guys, hopefully you really enjoyed that video. Hopefully it's given you some food for thought as well. If you've got any questions, please put them in the comments below. I'd be really happy to go through and answer them as and where possible. As always guys, if you've liked the video, please press subscribe, please like it, please share it, and get me up the Google rankings and get me up to the YouTube rankings. Finally, if you like more free content, there's a couple of places where you can connect with me. First of all, we've got the podcast which we release every Tuesday at 6 AM. It's called The Property Rebel. You can find us on all podcast platforms, whether it be Google Podcasts, Apple Podcasts, we're on Spotify, Stitcher, just to name a few. As well as that, you can connect with me on all social media channels. Find me on Facebook, LinkedIn, Instagram, Twitter, and Clubhouse, plus a few others, under the handle of Arsh Ellahi. Finally, have you downloaded the Property Investor app? It's the UK's first property investment platform which showcases all kinds of property deals all over the UK. Whether you're looking for below market value deals, rent-to-rent deals, lease option deals, service accommodation deals, just to name a few. All you've got to do is go to propertyinvestorapp.co.uk, or you can go to the smartphone app store, or you can go to the app store on your smartphone and type in Property Investor and download the app for completely free. It takes you 2 minutes to register and you'll see all the deals in the palm of your hand. As always guys, I wish you all to be safe, well and happy, and I'll speak to you all very soon. Thank you and bye-bye.